Good afternoon, everyone. We are going to go ahead and get started. Thank you for joining our Hawaii Economic Association online webinar, our last of the year. My name is Leslie Gabrielle Harvey, the Hawaii Business Consultancy. Mahalo to those who joined us and to our more than 200 members who have registered for 2021 membership. If you're interested in learning more about HEA membership, it's only $40 for the year to support economic education, discussion, and these events. Look for that additional information after today's webinar. Today, we bring to you a conference follow-on webinar looking more closely at diversification as a path towards economic resiliency in Hawaii. Many of our members joined today's webinar for free as a perk of membership. Thank you for joining us, and thank you to those non-members who have purchased the $5 Q&A access. Members and non-members who joined via Zoom have the opportunity to post questions and to participate in our poll. If you've not joined via Zoom, you might try it for the next event. Thanks to those who are joining us via live stream as the virtual platform becomes more commonplace. We really appreciate your support as we continue to navigate this and make adjustments in the future. Starting next month, we will likely have a live stream from our YouTube channel instead of the Facebook that we're doing now for improved video and audio quality. We appreciate your grace and willingness in navigating these adjustments with us. A special thank you to those who donated to our student fund and general donation fund. As a result of your generosity, we were able to provide significantly more to our scholarship recipients, as well as providing a nominal gift to many more economic students. Your generous contribution allows us to continue to provide these events without operating at a loss and supporting student access to events and student scholarships. And just a heads up, we will not be holding our webinar in January as it falls too closely to the holidays. We will pick it back up on February 4th, the first Thursday of February. Today, we are going to talk about an economic forecast featuring our panelists led by moderator Matthew Loke. Following each presentation, we will have a Q&A session. We encourage you to use the Q&A function. Feel free to send, comment, and upvote questions at any time. Matthew will solicit questions as time permits, prioritizing questions with a significant number of upvotes. And just so you know, we tend to have many more Q&A questions than what we have time for, although we have extended today's event by 30 minutes. We will try to provide some feedback on some unanswered questions after the event. Questions must be submitted through the Zoom Q&A function. As you saw, we've also enabled a few polls, one at the beginning and one at the end of this presentation for those joining us via Zoom. Your submissions are anonymous. The window, as you've seen, pops up, and we ask that you take a few seconds to respond. This feature, again, is limited to those who have joined us via the Q&A ticket. At the end of today's webinar, I ask that you take a few minutes to let us know how we did. Before you leave, check the chat function for a link to our feedback form. All registrants will receive the link via email as well. You'll also receive the slides and a recording in that post-event email. If you managed to join us today without registering, please still do so at headecember2020.eventbrite.com to receive that information. And just know that it does take us a couple of days to get those over to you, so please expect those no sooner than by the end of next week. Before we get started, I also wanted to mention our Facebook presence. We've been a lot more active as of late and would love to connect with you there. We share articles and information of interest, as well as our event announcements. Please find us on Facebook at Hawaii Economic Association. We would so appreciate you sharing our event flyers and supporting our mission of supporting economics in Hawaii, or even just liking our post. Now, to begin, Matthew Loke is a visiting faculty with UH-CTAR and affiliated with the Hawaii Department of Agriculture. His research interests include food security, food supply chain, food waste, agricultural and regional economics. His recent works have been published in the Journal of Dairy Science, Food and Energy Security, and Waste and Management Research. And I will turn it over to Matthew. Thank you.
Thank you, Leslie. Ladies and gentlemen, welcome to the HEA's first virtual economic forecast panel. As we were here last year, Hawaii's economy was already weakening and prospects looked increasingly uncertain. This year, we are all feeling the deep stress and strain of the COVID-19 pandemic. The lockdown in March left us stunned with unprecedented shutdown of the local tourism sector, leading to furloughs and sharply higher unemployment rates across the state. And it came with a run on paper goods, canned food, PPEs, and face masks. As the storm winds down, the catalysts to economic recovery are quite apparent in 2021. COVID-19 vaccines are a game changer, and I'm told that they'll be here in 2 weeks. Robust equity markets, strong financial fundamentals, and accommodating federal fiscal policy are other requirements. A quick look at the current economy shows two pictures, one that is half full and one that is half empty. I shall refer to the slide right now. Can you see it? Give me a thumbs up. Thank you. On the left side, you can see the S&P close on Black Friday from 2017 to 2020. The Black Friday of 2017, S&P closed at 2602. In 2018, it closed at 2632, up 1.2%. And in the Black Friday of 2019, it jumped 19.3% to 3141. And in 2020, the S&P closed at 360.38, up 15.8%. Over the past 3 years, it went up by 39.8%. So it's an average of about 13.3% a year. This is a pretty good return. So that's the economy seems to be bouncing back, looking at the S&P 500. But on the flip side, if you look at the chart on the right side, it shows food insecurity facing America in 2019 and 2020. In 2019, there was an estimated 35 million Americans who were facing food insecurity. The number jumped to 43%, or jumped up by 43% to 50 million. And locally, the Hawaii Food Bank typically spends $400,000 annually. In 2020, it is expected to spend $8.6 million. This is 21.5 times the amount of a typical year. Arising from this yin and yang economy, or as some call it, the K-curve recovery, it is perhaps wise to ask if the boom markets in equities and real estate will stay bullish. Both the Dow Jones Industrial Average and S&P 500 reached record highs recently. We know that businesses are still choking and struggling. So far, the current economy has been driven by Fed or central bank facilities and federal fiscal stimulus, pumping monies into the system through businesses, state and local governments to keep things afloat. Will this picture turn ugly when funding ends later this month? Likewise, will Congress provide another sizable stimulus package? With those questions in mind, I now turn to our distinguished forecast panel. As the chief economist at the Hawaii State Department of Business, Economic Development, and Tourism, Dr. Eugene Tian spends a great deal of time thinking, writing, and worrying about Hawaii's economy. He oversees DBED research on economic issues, including tourism, emerging industries, diversification, technology, energy, and taxation. His team also produces the official statewide short-range economic forecast quarterly and the long-range population and economic forecast every 5 years. Dr. Kyle Bonham was a founding member of the UHERO in 1997 and currently serves as UHERO's Executive Director and Professor of Economics. His research interests include macroeconomics, applied econometrics and forecasting, tourism economics, and the Hawaii economy. His current research focuses on mixed frequency models for nowcasting inputs for UHERO's quarterly Hawaii forecasting system. Recent publications include Forecasting in a Mix-Up World, Nowcasting Hawaii Tourism with Ashley Hirashima, James Jones, and Peter Furuki in the Annals of Tourism Research, and a policy analysis of Hawaii's solar tax credit with McKenna Kaufman, Sherilyn Wee, and Jermaine Salim in renewable energy. Dr. Bonham is a member of the State of Hawaii Council on Revenues and the House Select Committee on COVID-19 Economic and Financial Preparedness. The third panelist is the principal of TZ Economics, and Dr. Paul Brewbaker has been involved in Hawaii economic research as a commercial bank economist for 25 years and as a consulting economist for 10 years. He holds a PhD in economics from UH and is a certified business economist from NABE, or the National Association of Business Economists. Each panel will speak for about 15 minutes, and we will take questions from the audience at the end of the panel's presentation. With that, let me welcome Dr. Eugene Tian.
Aloha. Let me start providing some encouraging news about our economy. Our visitor arrivals recovered about 23% in November because November just concluded. And Hawaii's bankruptcy filing has continued declining. For the first 11 months, it's declined by about 9.4%, even during this recession period. And we have a personal income increase by 15.9% during the second quarter. This is during the pandemic. Initial unemployment claims have been stable at below 5,000 level since October 17. It has been 5 weeks, and today's number is even below 4,000. In December 2020, according to the airline schedule, today is about 935 more flights. This is in comparison with November. Will be coming to Hawaii, and of it there will be 84. There will be 84 more flights from international. Of the 84 more flights, the 42 will be coming from Canada. So this is the first time we have Canadian flights since April this year. Continue this encouraging news. Real estate market is performing well. In terms of real estate resale prices, the price increasing for both single family and condo on all the major islands except Kauai. The Kauai condo price decreased. In terms of average daily new COVID-19 cases per capita, Hawaii ranked the lowest in the nation. And this may be, I just called encouraging news. In another way, it may not be a good news because the mainland has been increasing. The COVID-19 vaccine will be available for distribution this month. There might be federal assistance money coming in 2021. I think the current amount is about $908 billion. If it is distributed by the percentage of population, I think we should get about $4 billion. So that if it is coming, it will be coming in 2021, about around the $4 billion. As Matthew mentioned that the stock market is doing well. In terms of Dow Jones, it had the best November since 1987. The outlook of the US economy has continued to improve. In May 2020, the blue chip forecast the US economy will decrease by 5.8%. And last month in November, their forecast is about 3.7% for 2020 and will be 4% next year. There are some challenging facts. We still have the high number of COVID-19 cases on the mainland, especially in California. And we have seen an increasing new cases in Japan, Korea, and Canada. That's we are thinking about to have the travel bubble with. The federal assistance program for current year, for this year, is coming to the end. And all industries started losing payroll jobs. So if you look at the October job count, every industry lost jobs. Construction activity was doing good at the beginning of this pandemic, but now is slowing down. And the state government will have revenue shortfalls. We may have some budget cut in the coming months. So this shows the COVID-19 cases as of yesterday. So as you can see that Hawaii is the lowest in terms of per capita or in terms of per 100,000 population. We're at the 5.5 and the US is for 49. So you can see that although California has been increasing and now currently is locked down, but their case is at the lower end. So the one state, Colorado, is actually above the middle, so within the 25, the top 25. So those ones with darker bar, they are 6 states. They sent more than 200,000 visitors to Hawaii in 2019. So we monitor those states closely. Look at this chart is the daily visitor count. So this is not, the blue line is the visitor count. We see that before the starting of the pre-test program is about 631 per day. And in the second part of October, it was about 4,000 per day. And in the whole month of November, it's about 6,000. And for first 2 days, it's about 5,700 in December. So this is increasing in November, but has been declining in the last few days. And look at the GDP growth for US and Hawaii. We do have the third quarter for US. The Hawaii third quarter GDP will be coming on the 23rd of this month. Hawaii has been following the US pretty closely in the recent business cycle. So you can see in the 2019 recession, we both decreased, but currently the US in the second quarter decreased by 9%. Hawaii was decreased by 13.9%. But the US economy is improving in the third quarter. The decrease was 2.9%. This is a year over year for the same quarter comparison. So Hawaii, we don't know what is this, we'll be expecting some improvement in the third quarter. This talk about the Hawaii GDP in comparison with the real GET. This is general excise tax growth. What I did is I lagged the GET collection by 1 month because the GET filing is 1 month later. And I also deflated by the consumer price index, Honolulu Consumer Price Index. So you can see that for the last recession, in 2009, or the general excise tax decrease is about 15%. So then our GDP decrease is about 5%. So the ratio between the growth rate was about 1/3. So if we are using the same ratio, currently our GDP decrease is at about 27%. So if we use the 1/3 rule, our economic growth, it may be decreased by about 9% this year. So we see that the general excise tax has increased in the third quarter. And this chart shows that our GT revenue has been stabilizing in the last few months. So now the gap is about 75 million. The GE tax is about 53% of the general fund tax revenue. So there is about 32% from income tax. So the GE tax, I believe, is the most comprehensive or most close indicator for our economic situation. So this talk about the bankruptcy filing. We have been, you can see in the last recession, we started the bankruptcy filing in 2008 and it became the peak in 2010. But currently, we still see a decrease compared with last year, 2019, and the decrease is about 9.4%. And this is the phenomena I have never seen this since I worked with the state for last 28 years. In the second quarter of 2020, we see a big increase in the personal income. So the growth rate is 15.9%. At the same time, we see the GDP decrease. So this implies that the household, we do have income. The federal government allocated about $10.3 billion to the state of Hawaii. So you can think about the $10.3 billion for this year, 2020. And I was thinking about for the $908 billion for next year, there will be about $4 billion coming. And it will be a lot of smaller than this. But this is the impact. The household have more income because of the federal money. And but the savings rate, it must be high. For the US, I think it is about 14% now. And as compared with the normal time, about 7%. I think households do have money and they have not spent them yet. And this shows that our labor market, we have seen the decrease during the last 7 months. We see a decrease above 17.6% of total jobs, payroll jobs, and the decrease is mostly happened in the leisure and hospitality industry. And this is the chart shows the unemployment claim. So you can see that today, the release today, it shows the week ending November 28th. It was below 4,000. This is encouraging. This is the first time we see this kind of a number since the October 21st. So this is a encouraging number. And we see the unemployment rate. If you look at it, the red line, that's for the US. And it is continuously declining. It's a straight line, but Hawaii was high. Then we have a dip. This is because of the second lockdown on Oahu. We did partner with the private agencies, and we did 2 surveys on the commercial rent. And the first survey concluded in July. It shows that we have 16% of our businesses, they closed. And the second survey was during the second lockdown. It shows that about 24% of our businesses were closed. And the new survey started Monday this week, will be concluded in the middle of December. We will have the result by later this month. I hope that the number of business closed will decrease. And this shows the construction industry. We especially see some decrease in the last 2 months. The construction industry has been doing good during the first few months since the pandemic, but this is the private building permit. It will impact the future construction. So you can see the total is a decrease by 7.7%. So the decrease is mainly in the residential and additions alterations. The the government contract awarded actually increased a lot. It increased by about 380%. That I think in the next year, the construction, maybe you can see there are two areas. One is from commercial, industrial construction, and the second may be government construction. And this shows the real estate market. When you look at the median price increase on all the island, the major island for single family, increase condo price, except Kauai. And this shows the home sales. This is the number of sales. You can see we actually started to decrease in last year, 2019, but we see a big increase in the third quarter this year, both for the residential and for the mainlander. We do have a decrease from international buyers. And this shows the blue chip economic forecast I mentioned at the beginning. So now the US economic recession will be decreased at 3.7%, and next year will increase at 4%. Most of the countries will have a recession this year and will increase next year. This shows the monthly flight. And as of today, this morning, because the airlines adjust pretty frequently, and you can see those pinkish 2 months, November and December. So you can see that's a lot of increases. So is almost 1,000 new flights coming in December. So this is the supply side of the visitor industry. And it is a good sign, especially those ones from Canada is 42. For Japan, it's also increased by about 41 flights. So our preliminary tourism economic forecast is that in 2020, this year, we may have about 2.7 million visitors. So that's a decrease by about 74%. And next year, we will recover by about 60% of the 2019 level of 10 million. And it will be about over 70% and 80% in the next 2 years. In terms of the unemployment rate, we will have some 11.2% this year, and it will stay high between around 7 to 8%. And for economic growth, will be at about 11.2% decrease this year. We'll have some small increase next year in the next 2 to 3 years. It's a small increase. It's not like the US will be at a 4%. So the economy will recover slowly in the next few years. I believe that's my last slide, and I will stop the sharing.
Thank you very much, Eugene, for that updated stats and very interesting forecast. I now turn the floor over to Carl. Carl, please take the floor.
Aloha. Thanks everyone for joining us today. This presentation, ideally it would have been our fourth quarter forecast. Unfortunately, it's not ready. And we expect to release it next week. The title of this presentation, Hawaii in Early Stages of Recovery, Then a Setback, is from our third quarter report. Unfortunately, it's still a good title. The setback that we experienced, that we wrote about in our third quarter report, was the summer surge of case counts on Oahu that led to a slowdown in economic activity and then ultimately to a second shutdown. The setback that we're facing right now is from the surge in cases globally, but primarily for us nationally, and also changes in policy. And that just reiterates what I've been talking about for some time now, is that the uncertainty that we face is so great. It doesn't make a lot of sense to call what we're doing forecasting. So what we've really been doing is scenario analysis, and I'll show you our current thinking on some of the scenarios. And as always, when you have these forecast presentations, there's a little bit of redundancy across speakers. I'm going to show you the numbers in a little bit different way. Eugene pointed to Hawaii real GDP and income. These numbers are quarter to quarter annualized growth rates. And so Hawaii has the distinction of having the weakest economy in the country, with a 42% decline in real GDP from the first quarter to the second quarter. Nevada was tied, but Hawaii had a weaker performance in the first quarter. So undoubtedly, we are at the bottom of the pack in terms of economic performance. And the national average for the second quarter, the US growth rate for the second quarter, was 32%. So you see pretty much all states had weak performances, but we stood out. And so this is lost output. This is, and it's very, very different than income, right? And Hawaii is at the top of the pack. We're not the leader, but we're very close. We're right up there with West Virginia on income growth. And so this dichotomy really is the result of a roughly $10 billion injection of federal money into the state economy, something that we desperately needed. It made the difference between households being homeless and households being hungry and not. And the question is, which of these statistics, the decline in GDP or the surge in income, is going to continue into 2021? And I can tell you that in our forecast that we're working on right now, it's not going to be the increase in income. While we may very well see, we actually, in the forecast we're working on, we are assuming that we will see additional PPP loans. We will see additional expansion of unemployment benefits. We're actually working on a forecast that assumes that there will be $300 of PUA unemployment benefits for the first quarter of the year, and that there could be a $300 plus up for everyone else for the first quarter of the year. That there will be additional PPP loans and possibly additional direct payments to households, but that's nowhere near the 10 billion. If we're lucky, the state will also see some support for state government. But any way you cut it, the year-over-year numbers are going to look much less rosy than what we've seen so far. And this is second quarter data. It's we're entering the last month of the fourth quarter, and as Eugene pointed out, we will get the third quarter data, but we're waiting for it. We don't really know exactly where the economy stands right now, and so this complicated graph that we'll have the quiz on at the end of the seminar today. This is our effort to understand where the economy is at any moment in time, and it's thanks to Peter Felecki, who did the work, and the sites are down in the bottom of the slide there. You can access that on our website. But what we're doing is we're constructing an economic index that we call the UHERO Economic Pulse, and we're basing it on 16 or 17 high frequency indicators of economic activity. A lot of them are mobility indicators, and so they're not measuring economic activity per se, but they're related to economic activity. They're related to getting out and getting close to somebody and networking with someone when their activity is happening. Some of them, so the ones that are colored, like the light green one here, is actually diners. It's the open tables data. And the orange one is actually workers who are at work, employed workers. The light blue line is actually small business revenue from Womply. The dark blue line is actually COVID searches on Google. Now, all of these are indexed, and actually the COVID searches is inverted also. So they're indexed to 100 before the pandemic, and then we see a trough right at the beginning when everybody is just completely locked down and afraid, right? And so the Google searches actually peak in early April, right? And as I said, we inverted them, so that makes it a trough. So it has the same behavior as the economy. And then as we squashed the curve, and when we completely demolished the curve by late spring, nobody's searching for COVID anymore on Google, and the economy has recovered. So we go from zero, we recovered 36% of the lost activity. And then what happened? Well, in early summer, actually the first couple of weeks of July, COVID cases on Oahu in particular went up 2.5-fold. And what happened? Everybody started searching for COVID again. Activity, people stopped going to work. Businesses, people stopped going to restaurants. And economic activity fell off even before the stay-at-home order. So the economic activity was being driven by the case counts even before we saw a second stay-at-home order. Then you started a recovery, which expanded with the safe travels. And the interesting thing is that this index, which is the dark blue line here, measured on the left axis, the index moves, we get the data weekly. So every Thursday when we get the new unemployment claims, we update the index on our data portal and share it with COVID POW. It tracks very, very nicely with total employment. And so it predicted the downturn in employment that we saw in September. It predicted the improvement in employment that we saw in October. We saw a roughly 30,000 person increase in employment in October. And that number, that increase coincided, of course, with the launch of the Safe Travels program. So it was a combination of reopening the Oahu economy, but also people going back to work to get ready for opening up to tourism. And so the index is pointing towards a stronger November. So we expect additional employment gains, an additional drop in unemployment for November. And it also is telling us that we're also using it to forecast third quarter GDP. We'll see in a couple of weeks whether the forecast is right, but it's telling us that after the 62%, I'm sorry, it was 42%. Just don't get overly excited here. The large drop that we saw in the second quarter, we expect that to reverse and quarter to quarter to see a small amount of growth, sub 10% growth from quarter to quarter compound annual growth rates. And so that's the challenge, and the thing that makes all of this uncertain is we're essentially playing whack-a-mole with the virus. And at the beginning of this month, beginning of November, and this is another piece of sort of redundant information. This is the daily deplaning visitors, and so these numbers came in stronger than what we assumed would happen in our third quarter forecast. So our third quarter forecast assumed October arrivals would be at about 10% of 2019 levels. And we got numbers closer to 18% on a year-over-year basis. We assumed, I believe our assumption for November arrivals was, I think it was 15%. And the number, by our calculation, November came in closer to 22%. So that was leading us to want to raise our forecast. And actually 3 weeks ago, I was raising our visitor forecast, not only because of the stronger than expected performance of the early data under Safe Travels, but also because of the arrival of the news that that a vaccine would begin to be rolled out, and it would be rolled out faster than we had originally anticipated. The problem is, you know what? I forgot to mention an important point. If I can get my slides to go backwards. Yeah, unfortunately, it's self-advancing. So let's see if I can just describe it. So in that last slide, the green bars were arrivals at Lihue, and there was a data point for yesterday. So Kauai has gone from an average of roughly 600 visitor arrivals per day to 19 yesterday. And so not only are we facing this risk from surge in the areas that Eugene also mentioned, the places where we get most of our visitors, and the size of these circles shows you the share of our visitors that came from each of these markets last year. And every one of them is breaking new records for COVID cases. And almost half of the United States is now under some kind of travel restrictions. And so that's a real concern that suggests to us that the tourism recovery isn't going to look like it did in October and November, at least for the next several months. and then you have the combination of changing the quarantine rules where Kauai opts out of the Safe Travels program, and we have additional restrictions on visitors that will require them to quarantine for 14 days if they don't get their test result before they get on their last leg. Those have potential to have very significant impacts on travel over the next 2 or 3 months. And so instead of raising our forecast, and I shouldn't call it a forecast because it's not a forecast, it's an assumption. These are the scenarios that we're working on, that we're plugging them into our forecasting model. And they're essentially, that 18%, these are 2019 growth rates, percentage of 2019 levels of visitors. And October was roughly 18% of 2019, November roughly 22%. And on our baseline assumption, our baseline scenario, we have December falling back down to 18%. And that continues all the way through February as you deal with the surge in cases on the mainland, the more difficulty time that visitors will have getting a test and being relatively confident that they'll be able to get their test results before they get on the plane, so that they, their entire planned vacation isn't spent in a 14-day quarantine. But then in the second half of the year, we actually increased our forecast a little bit because of the expectation that by summer or late summer, most of the population will be able to be vaccinated. There's still a lot of questions about how that rollout goes. There's questions about how many people will opt into to the testing. To the vaccine. And so the recovery is uncertain because it depends on the surge in the virus. It depends on policy about distribution of the virus, policy about our Safe Travels program. It depends upon the effectiveness of the vaccine and whether we begin to see any kind of side effects. And of course, it depends on the economic fallout from what ultimately is going to be a slowdown in economic activity in the winter for the United States as a whole. And our low scenario for Hawaii envisions basically going back down to almost no visitors. That's a 5% level all the way through March because of the spread on the mainland and because of changing policy in Hawaii. The optimistic assumes that you have a more rapid rollout of the vaccine and you actually have more testing capacity, and it makes it possible for people to travel safely. That's obviously quite optimistic right now. So anyway, we're introducing all of this into our forecast, and based on that, we will release a forecast next week. That, as I said earlier, the title of the forecast report could be left the same. We sort of had this recovery going. We put about 30,000 people back to work in October. We're probably going to put another 10 or 20,000 back to work in November, and then the surge in the virus and the changes in policy are going to basically stall things out, and we have to restart that recovery sometime in the early part of next year. And Eugene also talked about surveys a little bit, so I just want to give a little plug for the Hawaii Rental Property Survey. So this is something that Phil Garboden put together, our chair in affordable housing, and it's in collaboration with the boards of realtors across the state. And so any of you who are managing property or own property, and we encourage you to participate in that survey. Aloha.
Oh, thank you, Carl. Thank you for sharing that interesting scenario analysis. We'll be watching for renewed growth next summer. Okay, with that, now it's time for our third speaker. Please welcome Dr. Paul Brewbaker.
Thanks, Matt, and thanks everybody for joining us today. My colleagues have covered a lot of really important ground, so I'll be able to breeze through a little more quickly and hit some high points. My presentation is more about themes to think about in the coming year, and takeaways from what's happened this year that I think shape the way we think about the forecast, and maybe even longer term, looking out over the decade. So I think a lot of that's going to resonate with what you just heard from Carl and Tian. First of all, as Carl mentioned, things were looking pretty good in the third quarter. Then, for a variety of reasons, most recently the regional resurgence in the north central states of the coronavirus, and now it's spread elsewhere on the mainland. Winter doesn't look that good, and we're having to back up a little on our expectations for the coming quarters of performance, and definitely for tourism. So the theme here, winter is coming. That surge in the north central states, as I mentioned, reached a point where in the Dakotas, their case counts, their incidence, their daily incidence on a moving average basis was 3 times that of Wuhan, China in February. That's how bad it was. And we're relying on them getting a test before they get on a plane to come on their vacation. Yeah, that was not going to work out. Fortunately, thankfully, those numbers have come off. As Carl pointed out, people do respond even if their governments don't, and they change their behavior. And thankfully, we're seeing the impact of that across the north central tier from Montana to Wisconsin and down into Nebraska and Iowa, where things really came on late. But unfortunately, as Carl pointed out and Tian mentioned and showed a slide illustrating, there's a resurgence in places that have gone through this before in the spring in the Northeast and in the summer in the Sun Belt. And unfortunately, as Carl pointed out, many of these states are the ones upon which Hawaii draws heavily for tourism. So that impedes the tourism recovery, makes it difficult simply for people to get tests before they get on a plane. And obviously the protocols have been complicated accordingly. As Carl mentioned, after a sharp decline in second quarter GDP, the third quarter numbers nationally looked really strong. We expect to see something like this for Hawaii when the third quarter numbers for the states come out. And then the expectation was, and this is a NABE forecast from third quarter, the National Association for Business Economics, the expectation was that growth would decelerate to about 4 or 5% in the final quarter of this year and down to 3 and then 2%, the long run trend moving forward. It's really important to understand something about what Carl and Tian both alluded to, the fact that the root of the recession itself, unlike typical recessions where investment spending is the thing that leads and is interest sensitive and maybe responding to monetary policy, the current recession is a rare consumption-led recession where household decisions to pull back on spending and to increase precautionary savings, right? The flip side of lowering your consumption is that you increase your savings. It was that behavior in the spring as we all hunkered down and went into lockdown. And as Carl pointed out, changed our behavior before the jurisdictions imposed the lockdown. It was that retrenching after we'd stocked up on toilet paper that led to both the recession in the second quarter and then this extraordinary third quarter GDP number we saw nationwide, which represented in large part people coming out of their caves. Now, the fourth quarter real-time estimates from the Atlanta Fed, and fantastic, you heroes engaging in the same kind of nowcasting exercises where you use these high frequency data to gauge what the economic indicators will eventually tell us, those data are suggesting that the fourth quarter might have been even stronger than we were thinking a couple months ago. But again, as Carl pointed out, in just the last few weeks, we'd have reason to dial back those expectations. So this is what you'd see out there. If you go to the GDP Now numbers next week and see how they update, they might have pulled back. Both Carl and Tian made this really important observation that consumption declined in the second quarter, savings went up, production and employment declined sharply, as we know. So how is it that income was maintained at a relatively high level and in Hawaii's case actually grew? And the answer is that the federal fiscal policy response that was appropriate to the circumstances, the sudden appearance of a catastrophic economy-wide risk, that the CARES Act, that the federal fiscal relief, not so much stimulus, just relief, building a bridge over that chasm in production and employment, that worked. And of course, we've been waiting for 6 months for Congress to get its act together and extend or revise the terms of or whatever the relief package that bridged that gap in the spring. So when you look at disposable income, and by the way, like both Carl and Sean, if you get a copy of the PDF, all the links are in the bottom. You got to go check out these data. Personal income after taxes, both in Hawaii and nationwide, was largely maintained through the injection of transfers supplemented by special unemployment coverage, PPP loans, and other interventions. And if you look at the small print at the bottom, actually, if you look at the very small print at the bottom of the page, I calculate that savings went up 1.7 trillion in the second quarter. So you want to think about, how do you finance a $3 or $3.5 trillion federal borrowing funded relief package? You borrow from the people who've increased their savings by 1.6 or 1.7 contemporaneously. You literally go into the bond market, and a zero interest rates is not that big a burden. And if you don't do it, you're going to have something worse than the Great Depression. So that's why it's so important for policymakers to move forward. And we've been expecting this for a while. We've been expecting for the Congress to respond. And if you'd when you asked economists 6 months ago, back in the summer, what they thought the appropriate size of a follow-on relief package would have been, I mean, the survey said 1 to 2 trillion. One's probably not enough. 2, might be. You might not need to go more than that. And this week we're arguing about 908 billion, which is kind of like, okay, we'll take it. We've got 1 week to go. And of course, it's many of the other aspects of those programs, right? The moratorium on evictions, forbearance and bank lending, the foreclosure moratoria, all of those things should probably be, the suspensions should probably continue into the coming year when a sustained recovery can be mounted as a result of the rapid deployment of vaccines. The stock market is, as Matt started out observing, is higher than ever. I chafe a little bit now when I listen to people talk about record this and record that, because if you just look at the S&P 500, well, all you see going on is that at the start of the Trump administration, we had a really good run until he started talking about trade policy. And then the markets essentially decided, take 8% of the value of corporate America off the table because of bad trade policy, and then we'll just keep going again. And the return, as Matt calculated, is somewhere around 15%. The slopes of both these lines are 50%, 15%. And the second one is the regression pre-COVID. So all that's happened in the post-COVID era is that after the initial overshoot to the downside, the market's clawed its way back to the trend it was on already after taking the haircut for bad trade policy. So record whatever. The markets are looking through the bad things that have happened. They looked at trade policy, they said, take a haircut. They looked at COVID, they said, yeah, this too shall pass. And now we're back on that trend. So, curb your enthusiasm. Monetary policy has pulled out the stops, as everybody knows, and the Fed itself, who will be meeting next week, right, will no doubt reassure us that their commitment, this is from their September projections, to low or zero lower bound overnight interest rates, and as a consequence, low interest rates across the term structure of Treasury yields will remain in place for at least out to 2022, 2023. So you can take any worry there off the table, and it seems pretty clear that they'll, and we'll hear more about this next week, of course, but my guess is in December or the January restatement of the long run goals, they'll talk a lot about supporting the long end or dialing their quantitative easing asset purchases towards the longer end of the curve. So have no fear there. The Fed's own forecast for GDP growth is essentially the same as the market's. 4%. I'm sorry, that should be plus 4%. Should we change it? So minus 4% this year, plus 4% next year. That's a plus 4, not a minus. And then converging over the long run to 2% GDP growth. They've used their balance sheets very rapidly back in the spring when the financial turbulence occurred, in conjunction with other in backstopping, liquidity needs at that in that moment of shock as the novel coronavirus rapidly spread across the planet. They've used their balance sheet as they have ever since Ben Bernanke and the gang were back there in the post-Lehman environment to backstop the liquidity needs of the financial system as a whole, as I say, and also in this particular instance to support those unusual treasury requirements, various lending programs and whatnot, which you can see in the bottom of their liability side of the balance sheet there. And of course, having kind of used up their ammo at the zero lower bound for interest rates and with quantitative easing, full throttle, the Fed's moved towards forward guidance about where they would, posture with respect to various macroeconomic variables in the future. And in particular, this summer, they articulated a really interesting concept, this idea that, well, if you look at inflation, it's been below our 2% goal for the last 4 or 5 years, 2% on the personal consumption deflator, which translates to closer to 2.5% on the CPI. You're looking at CPI inflation rates here. And therefore, going forward, you should expect that we would tolerate inflation a little bit higher than our target, so that the average over some period, like say 5 or 10 years, would be about 2%. Not 2% as a cap, 2% as an average around which you should expect fluctuation. And since we've been below the target for some years, get the hint, we would tolerate being above. So that's a very dovish posture, and it's led, if you look to inflation expectations as manifested in the difference between nominal treasury yields and inflation index treasury bond yields, market expectations that inflation is likely to stay at or below for the moment, looking out, 5, 10, 20, 30 years down into the future on the term structure of inflation expectations. That's what you see here. And economists are happy with the Fed. That's all this survey says. Do you consider it to be about right? Yeah, 3/4 of economists say, yeah, shut up, move on. So let's drill down just a little bit. I mentioned the consumption-led recession as being sort of unique in this particular instance. The COVID recession. In Hawaii, it's worse than that because we have the domestic or resident consumers pulling back, but we also have absence of tourists and all of their consumption. And so when you look at the GDP data for Hawaii, about half of the 40% annualized decrease in real GDP was coming straight out of tourism, and then the other half coming from residents pulling back. And as a consequence, we all know the employment impacts. There's 100,000 fewer persons employed in Hawaii today than there were 1 year ago, and unemployment has soared as a consequence. You see a differential impact, the neighbor islands getting hit much more heavily because of their heavier dependence on tourism. And as a consequence, it's not just going on, of course, in labor markets. You're looking at weekly unemployment claims at the top of this slide here. But as Carl points out, we have these amazing high frequency data sets. And this is the Wampley data set to which he referred, which gauges how many small businesses are open and what their net revenue performance looks like. The mirror image, the increase in unemployment is reflected literally in the decrease in small business economic activity. And additionally, we have much more detail on consumer and household behavior and on worker behavior that I think present some of these themes that I thought I'd conclude with here in my portion of the presentation. So we've seen spending at grocery stores go up by about 20%. We've seen spending at food service establishments decline by 25 to 30%, right? We're eating at home. And the question is how much of that persists in the future? Spending, as I say, at grocery stores up 20%. The amount of time we spend at grocery stores has fallen by 20%. That's really interesting. That's a change in behavior. Again, because we're doing more of it online, we're getting stuff delivered, we do it more efficiently, we just don't wander around a crowded supermarket the way we used to. That changing behavior may be the kind of thing that continues on in the future and will have big impacts on retailing in particular, on food service, and in terms of economic activity, commercial real estate and other things. When you look at the mobility data, these are the smartphone tracking data, right? When you look at mobility data, comparing how much time people spend at home versus how much time they spend in the workplace, you get a really strong feel for another thing that's going on in the data, which is the remote work phenomenon. And interestingly, a lot of the retail activity, the co-movement between retail and recreation activity and workplace dwell time is very strong, even in the post-COVID environment. Right, you go to work and then you go shopping on the way home from work. So again, a big question here: how much will the work from home or the remote work environment, how long will that persist into the future? I think a structural change is already underway, and we'll have to keep our eyes on that. Measures of financial stress. I realize I'm running into a time constraint here, so I'm going to move rather quickly through housing market implications. The measures of mortgage delinquency we just looked at are not turning into foreclosures because we've adopted forbearance and we've deferred the foreclosure process until we can get the economy back going again. Really interesting pattern in the Oahu data where single family home sales are very strong, but condo sales are not. Single family inventories are shrinking, condo inventories are not. Part of that is people trying to get out of their vacation rental investments now that the city is enforcing its 30-year-old ban. But part of it may be this, people aren't commuting and they're looking for places to live that have more workspace. And you see this reflected also in the valuations where single family home prices have leapt back up to the trend pre-COVID, which had been stagnating the last couple of years, while condo valuations continue to languish in that sort of sideways motion that began to emerge in 2018 and 2019 when the population was declining, when net migration was outstripping other sources of population growth on Oahu and statewide the last several years. Again, without really digging in, it's hard to know, but some interesting hints in the data that if you look at where home prices are rising in the single family space, it's places like North Shore, Hawaii Kai, Kailua Waimanalo that sort of makes sense if you're thinking about where remote workers would want to live if they didn't have to actually live on the mainland to work on the mainland. So this phenomenon of remote work, it really looks like something that's going to be around for a while. Pre-crisis, 90% of people went to a workplace and never worked at home. Surveys back in the spring were saying that maybe as much as 25% of the workforce will work from home post-crisis. And more recent surveys of firms show that there's still a third of employees working at home full-time and another third that are working at least some of the time at home. Vast majorities are no longer working in workplaces for now. And when you survey workers, you see that they're starting to go back to work, but still a third of workers are working full-time from home and a quarter at least part of the time. So something has really changed. And when you ask firms in a forward-looking way where this goes, remarkably large proportions of employers are saying they expect remote work to be a permanent part of the future. And a final amazing statistic here, the number of applications in the third quarter of this year for federal employee ID numbers nearly doubled from its recent historical pattern, which was flat at the peak of the last economic expansion. And that just suggests there's something going on that's really changed. People are, maybe there's an entrepreneurial explosion occurring amidst all of this. So, hey, things changed after a pandemic. Don't forget, they called it the Roaring 20s for a reason. And I would say in this concluding slide that there are going to be big changes you see in retail and office space utilization. Right now, the industrial segment of the commercial real estate market is very tight as people like Amazon come in and build their, acquire or build distribution centers. And, I mean, my UPS guy has got to be here more times a day than my US Postal Service person. There are problems working at home, and we're going to have to sort through some of them. And as I once heard Ed Glazer say, I have no idea how to teach a 19-year-old mathematical economics over Zoom. So we're all going to have to figure this out. And I'll stop there.
Thank you, Paul. Thank you for tying up economic analysis to change in behavior from this COVID-19 pandemic. Very good panel discussion. Now we will move on to the question and answer session. I'll start off with Margaret. She asked, do you think the unemployment filing rate is skewed because of inefficient servicing by government?
Short answer is,
take that whole, yeah, Carl?
I mean, the short answer is of course, except I think the unemployment claims that Eugene was referring to were initial claims for unemployment, for regular unemployment benefits. And you know, if you look at the total, there's also initial claims for PUA benefits. And there's still, I mean, when you add up all the different components of unemployment insurance that's available today, it's not quite as optimistic as that declining initial claims number. It's actually a little bit more stagnant in November. But yeah, I think I know there have been some issues with people switching to the pandemic emergency unemployment claims, right? So that's sort of the federal version of extended benefits. So people who've exhausted their 26 weeks of regular unemployment claims would normally apply for extended benefits from the state, but now they're applying for the pandemic emergency. And I know there have been some challenges in getting those applications processed.
Thank you, Carl. Next question, this is anonymous. What is driving the increase in housing prices year over year?
A whole bunch of stuff.
Go ahead.
Demand exceeds supply.
Yeah. Yeah, I mean, it seems like the real question is how long that continues, right? There's there's a whole handful of things that would cause that demand to jump, and demand to jump mostly in the single family space and at the higher income range, the higher end of the price distribution. I mean, easy money, right? I mean, a tremendous amount of money flowing into the economy, low interest rates, a desire to trade up. Nationally, there seems to be an increase in first-time home buyers. One of the things that, and also an increase in second home buyers, and maybe there's a little bit of evidence that there are more people moving to Hawaii than there sort of have been in past years. So it's pretty weak evidence, but there is some of that.
That's great. Joe asked, do you have a forecast for Hawaii's inflation over the next few years?
2 is the number, and the number is 2.
Well, except that would be the old number, right? Before the Fed decided that they can run things hot, if they can accomplish that. Right?
Yeah, that's what I'm saying. I'm not sure they're going to get there. Yeah.
When Paul was saying they've been underperforming on inflation for, I think he said, for 4 or 5 years, my thought was, gosh, we must be getting closer to 10 years. I think they had 1 year maybe where they got close to their target, but yeah, 2 or 2.5 out in the out years.
Yeah, we have Janet Yellen coming back, so she's inflation hawk.
Yeah, she has to get through the confirmation process. So when Paul was showing his slides on food at home or grocery shopping and things like that, one of the things that occurred to me is that a primary area where we're seeing inflation is actually food. I mean, food that you're buying for home. Those prices, as I recall, that category of inflation is, as I recall, is up about 5% year to date. And part of that may very well be the way that we're shopping. It's really harder to do price comparison when you're trying to get out of the store quickly, and when you're worried that bag of rice isn't going to be available. You just buy it. It doesn't matter what the price is. But that's one of the things that we've seen changes is in what prices are going up and what aren't.
Another part of it is just the way the supply chain has been disrupted by the, it's the supply chain was set up for half of us, half of what we eat is at home and half of what we ate was in restaurants. And then all of a sudden that shifted in both dimensions by roughly the same amount. And the supply chain just wasn't set up to handle that. So it's remarkable to this day. You walk into the supermarket and you see these empty areas on shelves, which back in the day, if you talk to, Barry Taniguchi or one of these supermarket guys, they would say, I cannot afford to have empty space on the shelf. I only make a nickel on every ketchup bottle. I need that thing going off the shelf and going back 5 times a day if I can, because then I make 25 cents. So it's really impressive in a scary way how much the distribution system was shocked by our changes in behavior and how difficult in some of these areas it's been to, get to whatever the new normal has been. And in those cases, as Carl points out, there's going to be these misalignments. There's too much demand for stuff that can't quite get through the pipeline the way it used to. And those prices definitely responded. I mean, you see it in produce big time.
Right. Okay, moving on to the next question.
With your hydroponic tomatoes behind you there, Matthew.
Yeah, they're doing good now. Jerry asked, if tourism is expected to recover by 60% of 2019's observed tourism arrivals, can we expect that the accommodation industry to follow suit? Carl, quick one.
With a delay. I mean, it depends on what you mean by the accommodation sector. I mean, if you mean employment, I think you're going to see that employment will lag the recovery of visitor numbers, and spending may lag as well because of price discounting, right? So we're talking about bodies. So if you get back to 60% of 2019 levels, it doesn't necessarily mean you're going to be, you're not going to be back at 60% of 2019 spending, simply because right now room rates are down 30-35%, and it will take some time for those to recover. And the caveat to that is something that Paul mentioned is the short-term vacation rentals, enforcement of those rules on Oahu, and sort of the increasing cooperation of the platforms, in terms of cooperating with government in providing information makes it much less likely that that visitors are going to be coming and staying in short-term vacation rentals, which will then change spending patterns a little bit.
Okay, I think this next question is for Paul. Douglas asked, where did those savings go? Into the equity markets, which might explain the behavior of the financial markets.
I don't pay enough attention to know, and I haven't actually looked at flows of funds to see whether the increased saving is going into equities per se, but that's not an inconsistent hypothesis. And at any rate, right, any excess liquidity in the system is in the system. So if the banks aren't lending it, I mean, it goes somewhere, if only into interest-bearing or even non-interest-bearing deposits. The point is that the liquidity is available in the system for the borrowers to come along without having to require that interest rates move around to ensure a continuous equilibration. And of course, the Fed stands ready to keep that from happening should it happen. So it's, I know it's flowing in from households. I know a bunch of it's flowing out to the federal government, but that's just to the federal government and through the back door back to the people who don't have incomes because they've lost their jobs, or the businesses that don't have the income to which they were accustomed or that made them commercially viable previously through these lending programs with forgivable loans and whatnot. So it's kind of remarkable. I mean, I can't add it up. I'd have to go sit down and actually do the arithmetic, but it's there and it's helping and it's working the way it's supposed to. And it's kind of remarkable that it's taken the Congress this long to figure out that we need, we're we're halfway across, the chasm, and we need to build a bridge to the bridge over the remaining, part of the chasm. There's a bridge in Lyon or something like that.
There's a fair amount of research and data coming out from directly from large banks, and bank balances grew significantly. I mean, by the amount of the PPP loans and the direct deposits, and and so, as Paul says, it's in the system, right? Once those balances go up, the banks do something with it. They don't just sit. It's not the sort of 1930s view of how banking works. Those funds flow to all across the system. But one of the interesting things about this is that, or interesting to me anyway, is that I think our forecast for personal income in our last report was like, I don't remember what it was, -3% or something for Hawaii. And part of the reason that forecast was so wrong is that we didn't anticipate that the BEA was going to count PPP loans as income.
Yeah.
And we interpreted those as loans. They interpreted them as intended to be grants, right? And they won't necessarily all be grants, and so there may be some shaking out of this data as things go on. But anyway, that, like I said, it was interesting to me, maybe not anybody else.
No, dude, I spent an hour last night trying to sort that out, and that damn slide I had, and I was like, God damn it, I'm putting the slide in after all the work I put in on it. But you're right, it's in, if you look in the transfer payment part of the personal income statistics, you see PPP loans are like 3 different categories. Like, what? And then
that's transfer payments, right?
That's transfer payments. That's right.
That's PPP loans to like farmers and healthcare providers and things like that. But the big tranche is actually in proprietor's income, right? So it's actually showing up in income by industry. It's over $1 billion in Q2, and there's still, we had about 2.5 billion in PPP loans in the state, and so there's still more left to be counted, presumably in Q3. And then the challenge is that, at least the way that we do forecasting, is that income at the industry level ends up in your model, and it's hard to unwind it, right? So you have these persistency problems. But anyway, go on to the next question. I'll be quiet.
Hey, can I just ask something? Sarah, can you just take off the HEA slide? Do we really need that? Because if you take it off, I think we're all on screen.
Okay, next question. What policy action or inaction do you think would be most detrimental to Hawaii's recovery?
Inaction.
Yeah,
you got plenty of that.
Policy action or inaction?
Inaction would be most detrimental. Not doing anything would be most detrimental.
Well,
Carl?
I don't know. Sometimes the actions can be more harmful than sitting on our hands, right? It's, I mean, I guess I would argue that fine tuning the safe travels policy makes good sense, given the changes that we're seeing on the mainland with the surging case counts. But attacking that policy with a sledgehammer, it will be very, very harmful. I mean, the number one thing that the state can do for economic recovery, and by that I don't mean making sure that hoteliers take home a fat paycheck. I mean putting workers back to work and getting them off the unemployment rolls. And the number one thing we can do is to maintain public health safety while we allow visitors to come back to the islands and spend hundreds and hundreds of millions of dollars that, we're sitting around worrying about whether we're going to spend the last 100 million of the CARES money. But if you go back to a full 14-day quarantine, maybe because we didn't set up the infrastructure to make sure we can manage the relatively small number of cases that are coming in via travel, we're talking about losing many, many more hundreds of millions of dollars.
And by the way, we are still not using technology sufficiently to facilitate. I mean, what the hell, what planet and what century are these people living in? I'm sorry.
Okay, next question. What do panelists see as possible solutions or alternative scenarios regarding rental eviction moratorium? At some point, the moratorium would have to be eased off or addressed. So
That's a
maybe I should pose that to Eugene.
Thanks.
Yeah, that's a difficult question to answer. Yeah, I think, yeah, I would defer that to the two experts.
So, you know, I think that Phil Garbodin has written about this, our affordable housing chair, and but the best solution in the near term is to get more income support to low-income households and businesses, right? But in terms of a long-term solution for unwinding those moratoriums, that's just plain hard. We're going to see bankruptcies on the commercial side, and we're going to see homelessness and people doubling up, et cetera. And this gets at the sort of longer term issues in the housing market, is how these things get unwound. You know, when you have 20+% of households who are saying they're not paying their rent, and haven't been for 9 months, how that gets unwound is a really important feature that unfortunately I don't have the answer for. Maybe Paul does.
Well, the only thing I would say is that it's very transactionally costly for landlords and tenants, for lenders and borrowers, to resolve each and every one of the various impairments that we've deferred into the future. And what I would conjecture would be helpful would be for smart minds to sit down with legislators, unless this happens at the federal level, to provide a template for algorithmic resolution. So the idea would be, if you think it's in your best interest as one or the other parties, and the basic question is, who takes how much of a haircut does each side take? The landlord hasn't been paid. They'd like, Tutu would like to, right? That's her retirement income. She rents a condo and her tenants haven't paid for 9 months, and she's sympathetic with them, but that's her retirement income. So some kind of arrangement has to be made to get people caught up, to put the deferred amounts at the end of the in a bullet at the lease or at the end of the loan with an extension or a modification. If some kind of a formulaic algorithmic template can be established so that people have the option, we'll just go into the framework and accept, we mutually agree to accept whatever the algorithm tells us, and then have judicial foreclosure and litigation and however else it's going to work out happen on the outside. That seems just to me that there might be a way to get a framework for resolution that takes the heavy lifting of negotiation off people's already burdened shoulders.
So I think Paul's absolutely right about the heavy cost of all these transactions and coordination, and on the housing side, the rising prices really deals with a big chunk of this, right? Because there's really no particular reason for anybody to be foreclosed on, unless they just took out enormous, crazy amounts of debt. It's difficult because the rising values means it should be easy to restate those loans and or sell into a rising market and not have to go through foreclosures. But on the rent side, I really think it's got to be federal. I mean, because the incentive for every single renter is really to walk away.
Yeah,
I mean, it really is. It's just to walk away, because you're talking. I mean, think about it. You take a median rent of a couple $1,000s, and you haven't been at work, right? You own a bar or you work at a bar and you haven't worked since February, March.
Yeah.
Right. I mean, what are the prospects without just a pure complete transfer from the federal government to make you whole, what are the prospects for you ever digging out of that hole? It's just incredibly bleak.
Now, there is a case to be made, of course, that this is not your fault, nor is it your landlord's fault. It's a social phenomenon. We're in the boat together, and we should have a rule that says this is how much of the weight you carry, and this is how much of the weight you carry, and this is how much of the weight we will carry. We, the people, will carry some of that weight. And it's one of these things where it requires political compromise. Good luck with that.
And it requires political compromise at the federal level, I think. I just
Absolutely.
don't think it's happening at the state level. And, that's a risky proposition. We'll wait and see what happens in January in Georgia.
In Georgia, right? It's all down to Georgia. Oh, great.
It's okay.
No offense. I'm just saying.
This next question is directed to Eugene. Is there expected to be a layoff of state workers in December 2020? So I think the answer is no.
That's coming from a state worker.
Yeah, that's like, wait, I can see three right now.
I think the state is planning to do furloughs, but I haven't heard anything about layoffs. I think it's on the paper today talking about the teachers. So there will be, if for 10% reduction in the budget, there will be impact about 1,000 teachers. So there will be, I think the first, I think the governor will release the budget soon, and that will be having more details. But what I heard is that the state may start furloughs first, and there is no discussion about layoffs yet.
Can I jump in and raise an issue that's related to this? I'd like to hear what the other panelists have to say. But so the state faces a $2+ billion shortfall, and they've already done many of the things that you would do in a sort of temporary emergency kind of situation. You take money out of rainy day funds, and you take money out of all your savings accounts, and I believe they also decided to postpone funding benefits programs. So I think they postponed payments to the retirement system and things like that, which ideally you wouldn't do, but it is an emergency. And so if you think that this is short term, as all of us do, we just kind of differ a little bit on how long the recovery is, then doing things like 10% cuts to education and 10 or 15% cuts to the University of Hawaii, and everybody on this call is connected to the University of Hawaii and either graduates or work there. Those are things that do long-term damage, right? I think Matt could probably speak to the long-term damage done, at Department of Agriculture from the last round of cuts during the
2009.
The Great Recession, and so there must be some other sort of short-term solutions. And one I'll just toss out there is for the state to seriously consider selling some land. And I know that's a tough nut to crack. And so for example, or certainly make development of some state lands like the stadium much easier, and maybe try to draw some revenue from that as a way to plug some of the budget hole.
I'll just to add, this is a really important point. The short-term impact of what we're talking about will be a drag on the recovery, but it's equally important to remember that the long-term impacts as Matt's living evidence of this, and I still don't have agricultural data because Matt doesn't have a department to compile it, which is a small thing. But the big thing is that these kinds of changes have cast long shadows over subsequent expansions and subsequent generations. We're at risk of a generation of young people in Hawaii not getting the quality or the extent or depth of education that at a very important point in their moment in their lives when they can absorb it, it's important for us to provide it. So let's not trivialize the impact of budget cuts, notwithstanding the fact that they may be necessary, constitutionally required. Any kind of a workaround, almost any kind of a workaround can only make things better.
And just one last plug on that issue. You know, there's all this talk about diversifying Hawaii's economy and all these different directions we need to go to you know, help the recovery. If we pursue all these different ideas and simultaneously hurt all of the infrastructure that we have in state government and all the infrastructure we have in the education system, we'll end up much poorer 5, 10, 15 years from now.
Thank you for your comments. We are running short of time, and I guess I have one last question. This is important because it's coming from a Department of Taxation. So I'll ask you folks to respond.
We'll call Seth later.
What would happen to the structure, fiscal, home prices, new sectors of the state economy if tourism only reaches out 75 to 80% of previous highs? Is that lower long-term forecast even realistic? 20 seconds from each of you.
Yeah, I mean, look, 70, I don't remember what the target percentage was, 70, 80%. That's like 2017 levels. I mean, so the world wasn't over in 2017, right? We were talking about how wonderful it was at the time. So, you know, reaching back to 80% of previous levels of visitors is completely plausible, and it's consistent with, you know, with an economy that I think we can aspire to.
Thank you, Carl.
Yeah, 1989, 2019, every year in between was at or below. So that's the zone for us, is 70 to 90% of 1989.
Thanks, Paul. And closing remarks, Eugene.
Yeah, I think for the tourism forecast is one of the important components for the forecast. I think as Carl said, the forecast is mainly based on assumptions rather than based on the trend. So in the last 2 recessions, the visitor arrivals recovered both in 5 years. So that's why we assume that this time, at least in our projection, we assume it will take about 5-6 years. So the visitor arrivals our tourism market, the industry will not recover to the 2019 level until 2025. So that is based on the previous recessions and the current degree of decrease.
Thank you very much, our distinguished panelists. And thank you so much to the members of the audience for tuning in. With that, I will turn it back to our president, Leslie Harvey.
Thank you, Matthew, and thank you, Carl, Eugene, and Paul, for that great discussion today. Thank you for those who tuned in to join us and for your continued support as we navigate this new landscape in providing economic education. Before people sign off, I do want to draw attention to some issues that we've been having with access to our webinars. And I held off until the end so that we could hopefully capture more people. We have had some issues case by case with access to our webinar link. Note that you could still get our event notices, which is through a different program, but not receive the confirmation after you register for our monthly events. If you didn't receive the confirmation or any link to join the Zoom today and had to come to somebody on the board to request it, please check your spam and allow messages from Eventbrite. In addition, we found that some of these missing emails are attributed to people unsubscribing from Eventbrite emails completely, perhaps with the intention of limiting the marketing emails, but unsubscribing completely removes the recipient from all emails, including ours regarding the event. For both of these issues, spam and Eventbrite unsubscription, there's not a lot that we can do on our side except to provide some additional information, which we will do shortly and let you know how to resubscribe. But please do take a look at that. Each month we do have some issues with that link. We're trying to troubleshoot on our side, but it is challenging because it happens for different reasons, it seems. So with that being said, I want to again thank everybody for joining us. Attendees, please take some time to provide your thoughts on this event via the feedback form. You can find this link in the chat and here on the screen. It shouldn't take you more than 5 or 10 minutes to complete, and we really do appreciate your feedback and discuss it every month at our board of directors meeting. If you registered, you'll receive this link by email as well. You'll also receive the slides and a recording of the event. Just a reminder, we're an all volunteer board. Please be patient. You'll receive those by the end of next week. If you haven't yet registered, you can still do so until the end of the day. That way you're in that loop to receive the post-event materials. Thank you for joining us today. A special thank you to our HEA intern, Sierra Brewer, HEA Vice President of Programs, Reen Kamita, and HEA Vice President of Marketing and Membership, Paul Migliorato, for your work every month on our HEA events. And thank you returning attendees and those attendees who are joining us for the first time. Again, please find us on Facebook at Hawaii Economic Association. Stay tuned for additional activity. And we hope that you'll consider regular attendance at our monthly events. As mentioned previously, our January event will not be held, our regular January event, although we may have a special event in its place. We will be back to our regular first Thursday schedule in February, which puts us at a February 4th webinar. We strive to make our events relevant and beneficial to Hawaii's diverse business community by tackling topics that are pertinent and breaking them down to make them accessible to a broad audience. We hope that you found this to be the case, and we look forward to your feedback. Thank you very much for tuning in, wishing everybody a happy and safe holiday season, and we will see you in a few months. Thank you very much.
Happy holidays.
Aloha.
Thanks again, guys. Mahalo nui.